Hello and welcome to another session on Future of Finance is Green. In this segment, our focus is on the sustainable finance. And I have with me Sonja Gibbs, MD and Head of Sustainable Finance, Institute of International Finance. Sonja, glad to have you.
It's wonderful to be here. Thanks so much for having us.
My next speaker is Ms. Komal Sahu, the Chief of Sustainable Finance, AVPN, Asian Venture Philanthropy Network. Komal, glad to have you.
Very happy to be here.
So, ladies, I have a lot of questions specifically about the sustainable finance. But to begin with, let me ask a very basic question, which is a common question for both of you. And Sonja, I will start with you. How are financial institutions globally looking at sustainable finance?
I think the short answer has got to be from every direction possible. And I think this is because when you think about the impetus for the momentum in sustainable finance around the world, it's both bottom up and top down, right? I mean, there's tremendous demand from clients, from investors for new sustainable finance products, loans, bonds, across the spectrum. So that's one piece of it. The other is, of course, the growing policy and regulatory interest in sustainable finance. For many years, there was not a lot of action on that front. Since the launch of the Central Banks and Supervisors Network for Greening the Financial System in 2018, and the many changes in policy at the national level that have come worldwide, including with the installation of the Biden administration here in the United States, it's just a completely different landscape for sustainable finance. Then when you also layer in the growing commitments to ambitious climate targets, and here I would reference the Glasgow Financial Alliance for Net Zero, the Net Zero Banking Alliance, the Net Zero Asset Owners Alliance, there's tremendous reasons, impetus, factors behind the financial sector's growing interest in sustainable finance in all its forms. And it's not just the climate piece. I want to stress here that other areas like natural capital and biodiversity are increasingly in focus. You have at COP26 coming up in the first weeks of November, you'll have the launch of the International Sustainability Standards Board. You'll hear more from the Task Force on Nature-related financial disclosures. So in short, just all directions, sustainable finance as far as the eye can see.
And for us, yes. I would say, Amol, it's sustainable finance we look at as the entire continuum of capital. So we're a members network. We have about 600 members, and there's a large number of them that are financial institutions, private banks, Main Street banks, PE impact funds, and along them sit corporates and family offices and foundations. So when they talk about sustainable finance, they look at that entire continuum, and that goes beyond negative screening. It goes beyond responsible investing. It's looking at deep impact. And that deep impact has to be embedded and integrated in all products that are being offered to this investment base. And that's whether it's in the public market space or in the private investment vehicles, whether it's private equity, whether it's venture capital. And remember, for our members, E is important, environment is important, but S within the ESG is also critical. So when they talk about sustainability, they're looking at E as well as S, the social aspect of it. And even there, they're looking at thematic areas. It could be education, it could be financial inclusion, it could be gender. And again, as Sonja has mentioned, there's the regulatory pressure around this sustainable finance piece where, the EU set the standards and other markets are following, especially in Asia. But we also have this investor interest there. And we're seeing also in Asia, we're seeing this huge transfer of wealth happening from the current holders of private wealth to the next generation. And this next generation cares deeply about the planet, they care deeply about its people, and then profit. So again, the financial institutions have this impetus to step up and offer products, and they're moving the needle in the right direction.
Can I just add here to Komal's points, really important two elements of this. One is the kind of nature of fiduciary duty, right? I mean, for decades. You have this broad concept of fiduciary duty as being focused squarely on financial returns. What are you going to get next quarter for your shareholders? I think that the concept is really broadening quickly, right? To incorporate more of a kind of a shareholder approach to capitalism, and that's permeating throughout the investment world. So that's one element of it. The other piece you mentioned, Komal, that is going to be central, I think, in the years to come, is our understanding of what is green. So this whole question around product labeling and taxonomy, we've got to speak a common language. If we say that, a third of the world's assets are sustainable investments, what do we mean by that? Because if we don't hit that question, then we end up with the problem of being accused of greenwashing, which is a very challenging concept to define.
And there's a lot of press that's happened on that space. Yeah.
True. I think valid points. And, Sonja, that point specifically about the policy and, I think the shareholders, I think this is really valuable. Why is because, the companies look at the quarter to quarter and year to year profit. In fact, the agenda of the shareholders and the company's promoters is only to earn profits most of the times. And when you look at the sustainable finance, the challenge is that if they invest heavily into the carbon neutral kind of companies, the cost goes up. And then the challenge is that there is a less of profit. So considering all this background, Sonja, my question to you is what kind of policies are required to push sustainable finance to focus on green projects?
So I think in terms of the policies that we need, first and foremost, we need global alignment in policies. The world of global capital is global, without a doubt, right? You cannot operate in fragmented jurisdictions around the world. If you want to move capital efficiently, have capital markets at scale up sustainable debt markets in particular, you've got to have international alignment in policy and regulation. And this extends also to economic policy, right? Because the financial sector is an important piece of the equation, but without the appropriate economic, fiscal, monetary policies in place to support a green transition, the financial sector alone, can't do it. Let me give you an example here. In the run-up to COP26, this whole drive for alignment is centered on net zero transition pathways. So over 130 countries have now set or are considering to set 2050 net zero targets. And, the Glasgow Financial Alliance for Net Zero that I mentioned has over 160 firms across the financial sector. It's important to have this alignment across jurisdictions as well. I mean, clearly Europe has been a big leader in this space. There's growing momentum in Asia. The landscape in the US has been changing as well on the net zero front, both from a regulatory and a policy perspective. The Biden administration is very committed to tackling climate and policy issues, committing the US to a 2050 net zero target. So this agenda really continues to expand. We need to align around things like global standards for disclosure, for taxonomy, as we mentioned. And then finally, as we consider all of these targets, like a net zero target, how do we measure that? This whole question of, is your portfolio, your loan portfolio or your bond portfolio, is it aligned with net zero goals? That's another big question. What are the methodologies we use for tracking carbon footprint, for looking at emissions across the scale, right? Direct, indirect, supply chain emissions. And this is going to be a huge focus going forward.
Sonja, I agree with you. The alignment around the taxonomy, standardization is important because people know what they're working towards, what metrics they need to achieve. The IPCC report made climate a defining crisis of our time. And there's an urgency around it. Therefore, I think governments, public and private sectors, more than ever need to collaborate to address the challenge we've been presented with. We've seen this level of collaboration across various sectors, various geographies when it came to the pandemic. And we need a similar urgency, a similar momentum created around this. And that's where I think the policies need to change with respect to meeting this 1.5-degree target that we got set by the Paris Agreement. We've seen in Asia, we've seen monetary authorities as well as central banks step up. We've seen, for example, the Hong Kong Stock Exchange used to have ESG as, you know, you comply or you explain with the ESG disclosures. Listed companies had to do that. But we've seen the exchanges themselves evolve as well. So it's not just comply and explain. Now you need to do an annual filing with your report, same time as your annual report. So we're seeing an evolution happening there. I know in Singapore, I mean, the government, we actually have a ministry for sustainability and environment. And we have ministers appointed to deal with the issues that are arising around sustainability and give financial support towards it. Again, we're seeing a lot of incentives, for example, green bond programs. They've developed a framework. They work with different statutory authorities to build that green bond infrastructure, for example, in Singapore. And they're concerned about greenwashing. They're concerned about issues such as this. So they're actually giving grants to corporates to validate the sustainability and green credentials of the loan. So going from the macro picture of what COP26 is trying to achieve, governments need to step in at the micro level and deal with issues head on, such as I said, if you're going to avoid greenwashing, you have to be able to give the support that it takes to make sure that the institutions are able to meet those green mandates. There has to be a starting point somewhere. Again, the Hong Kong Monetary Authority's got a 3-phased approach towards this green and sustainable banking. They set a baseline for individual banks in their phase 1, and then they engage with industry and relevant stakeholders. They've undertaken consultations, and they've set forth a green and sustainability banking industry. They have set associations to make sure that they monitor and evaluate banks with respect to the progress that they're making. We have institutions such as Temasek step up, whether it's in collaboration with HSBC or whether it's in collaboration with BlackRock. They've set up a debt financing platform called, this is BlackRock and Temasek, both members of ours, it's called Decarbonization Partners. And they're going to deploy $1 billion, of which 600 million has already been committed by Temasek, to look at late stage venture capital, early growth stage private equity, advancing decarbonization solutions, and again, accelerating global efforts. So it needs to come from sovereign entities, it needs to come from government, it needs to come from regulatory authorities, and they all need to collaborate at the micro level, at the country level as well, to achieve these outcomes.
Can I add one comment here? And I think the point Komal makes about collaborative effort and market-led initiatives is tremendously important. I mean, one big element of decarbonization, if you think about the many sectors of the economy, these hard to abate sectors, as they say, heavy manufacturing, oil and gas, heavy industry, transportation, you can't just decarbonize there just through emissions reductions alone. You've got to have a mechanism, a platform for being able to trade carbon credits, carbon offsets. So this initiative to scale voluntary carbon markets that began with the Mark Carney initiated task force on scaling voluntary carbon markets is going to be a big part, and extremely global, extremely collaborative, 250 plus members across multiple jurisdictions all over the world, including Singapore. This initiative up and running is going to contribute to setting a global carbon price, which is of course very difficult politically. And many of the projects for carbon offsets are located in emerging and low-income economies that help bring capital flows to global south, protect natural capital, biodiversity, and so on. So multiple benefits here. We're really excited about this initiative.
But true, I noted your points. In fact, Komal, what you mentioned about the Singapore regulator, I think kinds of incentive they're offering are like really remarkable, which will kind of encourage, not only the BFSI companies, but the industry as a whole to look at this aspect far more aggressively. So Komal, let me shoot one direct question to you here, specifically about, since you have a large network here, how has been the response towards sustainable finance by investors, banks, financial institutions, since you have all these people in your network?
So definitely, I think we're seeing organizations, the financial institutions themselves, step up and make commitments towards 2050. For example, we have Nomura. Nomura is a Japanese securities and investment banking corporation. It's announced a series of commitments. It wants to make sure that it's pledged its lending, is transitioned in its lending and in its investment portfolios to align with its net zero commitments for 2050. In fact, it's joined the Net Zero Banking Alliance, which is to look at net zero greenhouse gas emissions itself by 2030. So we're seeing organizations like Nomura. We have another one, which is Wellington. Wellington is, an asset manager. It has actually got its own climate research center, which is studying the physical effects of climate change in capital markets, which impacts capital markets, impacts asset prices. So they're actually using that geospatial maps, integrating climate science data and financial data, and integrating this to make sure that they're actually informing the investment process, very deep analytics. So I think we're definitely seeing asset managers, we're seeing organizations step up, including all of the financial institutions. And this is, again, I would say, driven by investor interest as well. They're answerable. As Sonja mentioned, they have a fiduciary duty. They're finally stepping up to meet that fiduciary responsibility as well. So we're seeing some of that pan out in our members' investments and in terms of the offering of products that they're doing as well.
I do just want to add that the range of financial firms that are stepping up to the plate on sustainable finance. I mean, if you just look at our board of directors and the IIF membership, there is not one of these firms that isn't reorganizing internally, thinking of new platforms, appointing chief sustainability officers, really transforming their organizations to be able to respond to this need for sustainable finance. And I'd also make the point that, over half our members are from emerging markets, so including major banks in India like ICICI and Export-Import Bank and State Bank of India, major Singapore banks like DBS, I mean, really all over the world, and the same high level of commitment.
Noted your point, Sonja. Could you also elaborate more and maybe explain us more in terms of the initiatives that IIF is taking specifically in the segment of sustainable finance? Since you have a lot of this, what you can say, members from the emerging countries as well, what kind of initiatives are you taking with them so that they will follow the right path of the sustainable finance?
So I would divide these into two categories, one being on what you might call the risk side of sustainable finance, the other what you might call the opportunities side. So starting with the risk, I mean, this is front and center, right? I mean, climate risk has clearly been defined as financial risk and therefore risk to financial stability. So all of that is directly within the sphere of interest of banks. So we work to engage with regulators and policymakers. So that's global standard setters, the Basel Committee on Banking Supervision, the Task Force on Climate-Related Financial Risks, the Central Banks and Supervisors Network for Greening the Financial System, IOSCO, all of these global standard setters. We make it a point of engaging with and sharing private sector perspectives as they develop their approach to regulation and supervision globally. So that's one piece of it, engagement with regulators and policymakers. For example, the G20 Sustainable Finance Working Group, which is looking to coordinate and align efforts on sustainable finance around the world. It's co-chaired by China and by the US. So very significant efforts toward global alignment, which is fully supported by our membership. That's one piece. Another is around climate risk. There's a great deal of interest now in scenario analysis. What is the world going to look like 50 years from now? How much more are we going to get in terms of flooding, sea level rise, earthquakes? All of that has to be modeled both internally by banks and externally in terms of the reporting on the levels of climate risk that they have. So that's an important piece, along with the disclosure, along with the taxonomy that we mentioned. sort of, we need to speak the same language to be on the same page in terms of understanding risk and reporting on it. So that's all on the risk side, and that's all ongoing. On the opportunities side, as I mentioned, the Task Force for Scaling Voluntary Carbon Markets is a big initiative, but more broadly, our membership and the IIF generally for decades has supported sound capital markets development, efficient, liquid, and well-functioning capital markets. And as sustainability kind of takes over capital markets, you've got green bonds, blue bonds, bonds linked to sustainable development goals. You have transition bonds, you have green loans, green mortgages, green derivatives. As all of that develops, it needs to be done right with best practices and good standards. So that's an important part of our work on the opportunities side. And finally, I would mention the importance of scaling capital flows to emerging and developing economies. And in some sense, it's been a priority for years for the IIF to support such flows. Only now we're focused on the sustainability of these flows, and especially in areas like infrastructure, where climate resilient infrastructure is critical. And a lot of the flows that go to emerging and developing economies are related to construction and infrastructure.
Okay, valid point, Sonja. Komal, I have a very important question now. Since you have a network of large members and there is a rally specifically in the sustainable finance, but on the other hand, there is always a rally on whatever is trending. So for example, there is a great rally in a startup space, there is a great rally in a fintech space. My question to you, Komal, is, since many members of your network wants to go ahead with sustainable finance, how serious are they? Are they really serious about, investing in a carbon neutral, the companies which have a target of carbon neutral, or they just want to be part of the rally, which is, globally quite glamorous these days? No, sustainable finance is quite attractive and let's, go ahead with it. Or are they really serious about environment, about social goods, about ESG, or about everything?
I would say that, at the end of the day, it has to be a financially compelling opportunity as much of it as it is a social and an environmental outcome. Those two need to go hand in hand. It's a balancing act. And I, from an investor point of view, everybody who's part of our network and looks at it from an investment lens understands that there may be some aspect of concession they're prepared to take on board for a deep impact, but most of it, there has to be a financial return as well. So in the last few months, as we've seen during COVID, a lot of it's gone virtual. We've been having a lot of these Zoom type of conversation with our private wealth holders, with our banks, and we are seeing that they are all talking about products that have financial outcomes as well. And I think the learning has been that you can do good and do well at the same time. And sustainability is not just a fad. It's something that will result in longer term opportunities, longer term potential financial outcomes, and not just for the near term. And many of these families look with a long-term lens because these are multi-generational businesses. And we've been hosting a lot of these dialogues within AVPN.
Got that. Sonja, do you want to add something here? I will also, ask a similar question in a different manner. And that question is, whether at one side, the policymakers and BFSI companies are now talking about sustainable finance, but this goal will not be achieved until and unless industry is aiming and making a goal to become a carbon neutral, right? So do you see, what is the sense that you get from the industry? Are they really serious about going for carbon neutral? Are they really serious about protecting an environment? And are they really serious about the whole climate change game?
Dead serious. And I think that, Komal had mentioned earlier, the latest report from the climate scientists, the IPCC report, which emphasized the urgency of our task, that we have very little time left to have any chance of meeting our climate targets, and that the responsibility for climate change is very clearly attributable to human activity. And it's a real departure for them and a serious warning. So I think companies increasingly are scrambling, are desperate to figure out how they can help. I want to distinguish here between carbon neutrality So in other words, not increasing carbon emissions and achieving carbon reduction through offsets, and net zero. So reducing carbon emissions to their lowest amount and offsetting the remainder. They're kind of different concepts. So different countries, for example, will commit, and companies will commit to different elements of this, carbon neutral or net zero. And it's no easy thing, right? Especially for the hard to abate industries that we had mentioned, the heavy industry, the manufacturing, the transportation sectors, oil and gas. And they have the steepest challenges in terms of R&D. And the impacts of climate change are irreversible. So the success, I think, is going to depend in large part as well on the real economy transitioning, not just the financial sector. And, the hard to abate industries are going to be a key part of that, which is why transition finance is so important for our members. It's not just a matter of, providing financing for green things. That's in some sense the easy part, right? You can finance a wind farm or, a solar panels. That's great. But how do you help oil and gas companies reevaluate their entire business and transition toward a newer, greener business models? How do you bring down the cost of the green technologies, the clean technologies we need to make all this happen? So I think transition finance is a very big, important, and serious part of this whole set of questions.
Okay, I think very meaningful, again, thoughts here, and again, it's a need of the hour. And I'm so sure, the regulators will also look at it far more aggressively than they're doing it right now. My question here is, at one side, the regulators are also thinking about crafting policies which will encourage banks and the finance companies to give credit to only those companies which are thinking about carbon neutral. But is it really helpful if the central banks make it mandatory for BFSI companies to give credit to those companies? Will it be helpful?
I think we're looking at emerging markets, right? And at the end of the day, these emerging markets, what we need to do is help mitigate, as Sonja mentioned, transition, choosing to, fire your industry with renewable energy, giving funding towards that such that transition can be made. If we stop funding altogether, then in emerging economies, it's not feasible. I mean, the economies drive to a halt. The industries drive to a halt. So there has to be a balancing act. And I think there is a recognition of that across the globe, that the transition that will happen in the West may be faster in comparison to what's happening in emerging Asia. We're not just looking at, and again, if you look at countries like China, I mean, the rest of the world is committing to 2050. China is still sitting with the 2060 targets. And if you look at China, you're looking at a very fossil fuel, despite all that it's invested in renewable energy, a very fossil fuel dependent industry, very fossil fuel dependent power generation. So it's going to take a lot of regulatory effort. But it's also going to take an understanding, political will to make sure that industry still survives, but is able to transition as well. So no, I don't think you can have regulators mandate at this stage you only lend to those industries that are committed to carbon neutrality, because I think economies can't grind to a halt.
Yeah,
certainly.
Such
Sonja,
important points. Such important points, Komal. And Amol, you had mentioned specifically the central banks, and I wanted to share a few perspectives here on central bank oversight of the financial sector. I mean, when you think about what central banks do, they have a microprudential line of supervision, which is directed at the individual banks. What are the risks to a bank's own balance sheet, say? A macroprudential, which is more on the greater financial stability of the system. And just about all central banks are, have those two sort of strains within their mandate, right? When you go further than that, and you had mentioned, mandating a particular type of financing, or what you might call active transition, steering financial sector capital. Not all the world's central banks are going to be comfortable with that set of directions. In particular, I'd highlight the US here, where that's specifically not part of the Federal Reserve's mandate.
Right.
However, I think just about all central banks now are contemplating or are actively using climate scenarios to model what goes on in the future, which can inform stress testing for regulated financial institutions like banks. And then that informs things like the capital framework. So how much capital do you have to hold against a green loan versus, say, a brown loan? So in that sense, the kind of tweaking of the rules of the financial system to incentivize green financing or penalize brown financing, a lot of that is already taking place at different central banks around the world.
Okay, noted your points. I think very valuable points, and good to see. In fact, central banks, Central Bank of India, Reserve Bank of India, is also thinking in the same direction, and we could see that in their FSR reports, the recent reports. I think the time was up. Watch is ticking, but let me tell you one important question with both of you. We partly discussed in the first question, but let's talk about the future. Let's talk about the outlook. And Komal, I will come back to you. How do you see the future of sustainable finance in next 3 to 5 years? Because where we are today, we have crossed a lot. I mean, we have the water has flown a lot since last 5 years. I think compared to what we were 5 years back, I think we have made a lot of progress. At least we have started thinking about it. Considering where we are today, how far will we go in next 3 to 5 years in the area of sustainable finance, according to you?
Hi, Amol. I would say that I think we've already got the code red for our humanity right now. We are in a marathon to this net zero. COP26 is going to be a game changer. Countries are going to have to come and make commitments. They're going to have to align on what they're going to do in the near term. And 2030, the SDGs 2030 is the near term so it's 9 years away, but there will be milestones along the way that countries are committing to that will need to be met. So I think we're going to see a huge growth in this. I think the Bloomberg article that I looked at mentioned that by 2025, we're going to be looking at 53 trillion invested out of 140 trillion, which will be what will be global assets under management by that point in time, sitting in ESG related assets. So I think the sustainable finance space is growing. Those are the kinds of figures that are being bandied about. So I think this space is here to stay, and we all need to commit to it, and we all need to collaborate as different stakeholders to commit to it. And media, of course, has its role to play as well.
Thank you. That's why the session is here. Sonja, your views as well. How do you see the future of sustainable finance in next 3 to 5 years? I can
only echo what Komal said. And, the expression, at least in America, 0 to 60 in terms of the accelerator on a car, but you have to multiply that by many times. So maybe it's 0 to 600 on sustainable finance. And then the other observation I'd leave you with is something that when the Network for Greening the Financial System, the central banks and supervisors, was launched, I was at that launch event, and I remember very clearly something that Frank Elderson, who chairs the NGFS, said at the time. In 30 years' time, we're not going to have a network for greening the financial system. We're not going to have a sustainable finance department, at a bank. It's just going to be integrated across everything that we do as central banks or as financial firms. And I think that's absolutely true.
Fantastic. I think I'm done with my questions, and time is also up. Wish I could have taken more questions because this is really interesting. I actually didn't want you to go and share more insights, but let's maybe do a sequel of this very soon. Thank you, Sonja. Thank you, Komal, for sharing your perspective here. Thank you so much for joining at Economic Times Global Town. Thank you so much.